anyway, just I quickly speak a little bit about while I was gone. I know there was a blog piece written that was very critical of our investment strategy. And, it's funny, too, because when that piece came out, when that article came out, I mean, it was like there was some gigantic revelation. Oh my gosh, Euro Pacific capital accounts are down. I mean, I don't know how anybody would be surprised by that. I mean, I talk about it all the time. We talk about it on this program. I talk about it on television. I talk about it on the radio. My investment strategy has been no secret, at least, a substantial part of it, which is to buy foreign stocks, to get out of the dollar, to buy dividend-paying foreign stocks. Of course, part of my strategy is to buy commodities, to buy gold, and obviously, when you have a situation where the dollar is going up and stocks are going down all over the world, I think 2008 was the worst year in history for foreign stocks. If I'm telling people to buy foreign stocks, they're obviously going to be down in 2008. Why that's even news, why that would even surprise people, that people who bought stocks based on my recommendation that those stocks would be down. I mean, it's just, Now, obviously, too, I talked a lot about shorting stocks and about the fact that financials were going to go down and the U.S. market was going to go down. And, many of my clients do short stocks, and a lot of them do it through discount brokers. I mean, they don't necessarily do it through me because I'm not a discount broker. So a lot of people who are shorting stocks based on my, advice or, my take on the market, they're doing so in non-Euro Pacific capital accounts, although there are some clients who are shorting in their Euro Pacific capital accounts. But, a lot of people prefer to do it where they can pay a discount commission. We have mainly the people executing the foreign stocks in my accounts because that's where I can add value because we can save money by buying these stocks directly on foreign exchanges. So if people want to short U.S. stocks and buy foreign stocks, and generally they short their U.S. stocks someplace other than Euro Pacific capital, and they buy through us. And the money that, my clients are sending me are the money that they want me to invest in foreign stocks. They're not sending me the money they want to keep in cash. If they want to keep it in cash, they keep it in cash someplace else. Of course, we also buy a lot of gold for people. People send me money to buy gold, but, the gold that we buy through the Perth Mint does not reflect on any of the Euro Pacific capital statements because the gold is held at the Perth Mint. To the extent that my clients want to buy physical gold to have in their possession, which I also recommend, I just suggest that they go to a local coin store. I don't buy that for them, but I certainly recommend it, and I tell people that they should have physical gold. But the fact that our accounts are down, of course. We're in stocks. I'm a value investor. I'm a long-term buy and hold guy. I'm trying to get out of the dollar. And obviously, during years when the dollar is up and stocks are down, the accounts are going to go down. But we're not keeping score on a short-term basis. Obviously, you can't evaluate a buy and hold strategy just based on a downturn in the market because that's when it doesn't work. But over the long run is exactly when it does work. And the people who think, no, you should trade the market, you should buy and sell, yeah, in theory it's great. Yes, sell before it goes down and buy before it goes up. But it's a lot harder to actually do real time. With the benefit of hindsight, it's always easy to know. And I find it interesting that a lot of the people who are so quick to say how easy it is to time the market, it usually, they usually don't have any money. And if they were such good market timers, if they always knew exactly when to buy and sell, why aren't they rich? Most of the people who claim to be able to trade the market, if they really could trade the market, they would just shut up and trade it. Like, for instance, the guy that wrote this blog, that's criticizing me, apparently the guy's been a money manager in the business somehow for 10 years or 20 years, I read, but his firm is not even SEC registered, which means he doesn't even have $20 million in assets or $25 million in assets. I don't even think he has even half of that or a quarter of that. But if he's such a great market timer, if he knows exactly what the markets are going to do, why does he even need clients? Why is he even advertising for clients? He should just be so stinking rich. It's just easy for people to pretend that they know how to trade the market. But if they did, they wouldn't be drumming up business. I've always told people that I'm not even attempting to time the market. Maybe it works in the short run. But I think in the long run, it's not the prudent thing to do, especially when we're trying to prepare for a event is catastrophic as what I see coming in the United States. You know, a lot of people are making a big deal about the fact, oh, Peter Schiff, predicted the collapse, but look, his clients are down. Well, the collapse hasn't even really happened yet. I mean, that's the funny thing. The people who are giving me credit for having predicted the economic collapse, what they don't understand is that the lion's share of my prediction hasn't even happened yet. I mean, what we've seen so far is just the beginning, right? The bursting of the housing bubble, the bursting of the credit bubble, the beginning of the recession. This is not the crisis. This is what's going to lead to the crisis. Remember, the real crisis is not the bursting of the bubble. The real crisis is what the government does to reflate it, which is exactly what they're doing right now. And this is where the destruction of the dollar comes in. This is where the massive inflation comes in. It doesn't show up immediately when the bubble bursts, but it shows up as a result of what the government does to try to save the economy. And so ultimately, when this scenario completely plays out, this dollar rally that happened in 2008 will reverse, and the dollar will collapse. And then, obviously, all the anti-dollar stocks that we invested in will do well. And meantime, we're collecting our dividends. You know, it was interesting. The Wall Street Journal came out with a story also following up on this blog piece. And in that Wall Street Journal story, it's, they quote somebody in there that says, oh, Peter Schiff's strategy is very risky, it's not balanced, it's not, it's just a risky bet. Well, the reason that they're saying this is because it's not in dollars. They're assuming that my goal is to preserve dollars, to have a balanced portfolio in dollars. They thought, they're looking at my portfolios and saying, oh, these are 100% foreign, that's not prudent. That's a big bet, that's very risky. They only think it's risky based on their own perspective, which is that the U.S. dollar is safe. But if you've come to the conclusion like I have, and like I think a lot of my clients, which is why they've sent me money, if you think the dollar is going to collapse, then it doesn't make sense to have any money in dollars. You have to get your money into foreign assets if you believe the dollar is going to collapse. Obviously, the mainstream guy that the Wall Street Journal went to look at this particular account to say, oh, this is very one-sided bet. Schiff is making a risky bet. In my mind, I'm not making a risky bet. I think the risky bet is keeping your money in the United States, keeping your money in the dollar. Now, of course, the particular portfolio they were looking at happened to be a portfolio that was, I think, 70% commodity companies, resource companies. So